So, Michelle, give us your initial reaction to this second read on GDP and personal consumption.
Well, I'm encouraged, of course, by the fact that it was an upward revision, despite, as you said, the downward revision to consumer spending. But let's face it, the consumer numbers, even after this very small revision, were very healthy in the second quarter. I like the upward revision to business investment. I was very encouraged by the strength in the durable goods numbers that we saw for July, which suggests that the, importantly, CapEx spending strength is continuing. There's been a lot of concern by many that the tariffs may be spooking companies and causing them to pull back on capital spending. There's no evidence of that in the numbers, the second quarter, and then the early Q3 numbers. To me, that's probably the most important thing I'm looking for going into the second half of the year. I think the consumer's on very solid shape. I want companies to be able to continue to invest as well.
Jim, how's the Fed likely react? We just heard out of Jackson Hole, they said it's still growing, we can keep raising.
Yeah, so it's a question of how much inflation is this going to generate and how much does this translate into wages. And so far wages have been going up, but they've been going up at a relatively slow pace. But look, I mean, the numbers here, as Michelle was saying, you know, consumption and investment, that's really, really good. I mean, as parts of components of GDP. Now, what does this lead to in terms of productivity? Now, if we have the CapEx, if you have the investment, ultimately this should lead to higher productivity going forward, which means that you could have more sustainable growth. So you asked a question earlier, which is how sustainable is this? How you know, can we stay at these levels for very, very long? Well, you can if you get a substantial increase in productivity. Right now, what we're seeing are the seeds to that. It's still early days to say it because it takes a while for this to go through. But nevertheless, you know, this is a strong number. This is very supportive of what's been going on in the markets.
You end up having consumer spending, though, at 3.8%. That's how much it grew, down from 4%, which is what we had thought it was going to be. And if you take a look, say, at what we saw with consumer confidence yesterday, sort of blowing out here, Michelle, the rhetoric was that the four handle can't continue. If you have consumer confidence so high, can the four handle really continue?
I think the key, even more than the confidence numbers, is, of course, income and job growth. If you want to talk about whether or not consumers will continue to spend, it boils down to that. And that's why it comes down to the business sector continuing to want to hire and invest. And I think what Jim was talking about is absolutely critical. The seeds for better productivity growth are being planted. It's better productivity growth that will allow companies and encourage companies to pay more for workers, though that will, that'll put more money in consumers' pockets. And again, it makes the case for sustained growth. The really important thing here is really is how sustainable, because a lot of the recession talk that I hear, the 2020, the looming fiscal cliff, is focused on the fact that this is a sugar high that we're seeing, particularly in the consumer sector, as a result of tax cuts. I don't think that's the big story at all. I think that this is stimulus that's encouraged businesses to hire more and invest more. It's sowing the seeds, as Jim said, for better productivity. That sets the stage for better wage growth. And all of this, I think, means that consumer spending can be sustained as we look ahead.